Hello everyone, welcome back to Stock Market Meridian. Today is 18th August 2026 and you're watching today's post-market report. Today the Indian markets opened with a gap down and throughout the trading session we witnessed strong selling pressure. By the end of the session, both benchmark indices closed in the negative zone. Now let's understand what triggered today's market weakness and which sectors and stocks were responsible for the fall. Coming to the sectoral performance, the IT sector and reality sector were among the top losers today. On the other hand, the media and auto sectors were among the top gainers. Looking at individual stocks, the major losers today were Tata Motors Passenger Vehicles, Asian Paints, Infosys, Wipro and HCL Technologies. And on the gaining side we had Axis Bank, Max Healthcare, Mahindra and Mahindra, Grasim Industries and Power Grid. So the sectoral and stock level performance clearly indicates that the IT sector was one of the major reasons behind today's market weakness. But why exactly is IT under pressure? Let's understand. Indian IT heavyweights extended their decline for the third consecutive trading session. The pressure is coming from a combination of two major factors: rising US Treasury yields and surging crude oil prices. The US 30-year Treasury yield surged to an intraday high of 5.326%, its highest level in almost 20 years. At the same time, the US 10-year Treasury yield moved up to around 4.7399%, marking a 19-month high. Higher US bond yields increase borrowing costs and can put pressure on equity valuations, particularly growth and technology stocks. And there is another major concern: crude oil. Brent crude futures moved above $91.26 per barrel, extending gains for the third consecutive day. The rise is coming amid escalating Middle East tensions, US-Iran standoff risks, and concerns surrounding crude oil transportation through the Strait of Hormuz. Higher crude prices can increase inflationary pressure across major economies, and that raises concerns that the US Federal Reserve could keep interest rates higher for longer. So rising bond yields plus rising crude prices are creating a clear risk-off environment for global equity markets. Indian IT exporters were among the biggest losers on the Nifty 50 today. The Nifty IT index declined around 1.8% to 30,253.4, entering a technical consolidation phase after its strong recent rally. Among the major IT stocks, Infosys and HCL Technologies fell nearly 2% each. TCS, Tech Mahindra and Wipro also declined by more than 1%. From a technical perspective, the Nifty IT index faces strong resistance around 32,000. If the index continues to trade below 30,900, the next important support levels could be around 30,000 and 29,500. However, if the index manages to break above 32,000, the next upside targets could be around 33,500 to 33,800. So traders should closely watch these levels in the coming sessions. Next, let's talk about Bajaj Finserv. Motilal Oswal has reiterated its buy recommendation on Bajaj Finserv with a target price of 2,490 rupees. The brokerage believes the company is entering a phase where insurance and emerging digital businesses can provide stronger earnings visibility alongside its core lending business. The company is increasingly focusing on profitable and higher quality growth rather than simply chasing market share. In general insurance, the company continues to maintain strong combined ratios by avoiding unviable and mispriced business. In life insurance, the focus is shifting away from low-margin ULIPs toward protection, guaranteed return products and annuities. Meanwhile, emerging businesses such as health, markets and asset management are gradually scaling up while reducing losses. The board has also approved setting up a reinsurance business, initially focusing on domestic opportunities before potentially expanding internationally. Bajaj Finserv is also expanding into areas such as wealth management and pensions. And of course, Bajaj Finance remains the core engine of lending growth. So the broader strategy is to build a diversified financial ecosystem rather than relying on just one business segment. Now moving to BSE Limited. BSE shares extended their decline for the second consecutive session after major brokerages Nuvama and Jefferies downgraded the stock. The key concern is the impact of the newly introduced closing auction session or CAS, along with regulatory changes affecting options trading volumes and premium decay dynamics. Nuvama Institutional Equities downgraded BSE to hold and reduced its target price by 21% to Rs 3,240. Jefferies also downgraded the stock to underperform while cutting its target price by 16%. Nuvama additionally reduced its EPS estimates for BSE by 6.3% for FY27 and 15% for FY28. Another major concern is trading activity. BSE's average daily premium traded volume dropped to around 18,100 crore rupees, the lowest level since January 2025. Its premium market share also declined by 130 basis points to 36.3%. Jefferies highlighted that BSE's options average daily traded turnover declined around 12% month-on-month in August. The impact is particularly visible around expiry sessions. BSE expiry day contracts dropped by around 33.2% compared with a 23.6% decline in non-expiry contracts. The introduction of CAS is also changing the dynamics of options trading. Previously, option sellers could broadly anticipate premium decay toward the close. But with greater settlement price uncertainty under CAS, premium decay has become less predictable. That can reduce the participation of intraday option sellers and affect trading volumes. On top of this, stricter collateral requirements are increasing capital requirements for brokers and proprietary traders. So the key question for BSE is whether trading volumes can recover and whether volatility returns to the market. Now, on the other side, we have NSE. The National Stock Exchange has completed major international roadshows to attract top global institutional investors ahead of its proposed public issue. During these meetings, NSE reportedly marketed its shares in the range of Rs 2,000 to 2,100 rupees per share. At the upper price of Rs 2,100, NSE's implied market valuation could reach approximately 5.26 lakh crore rupees. At this valuation, NSE would rank among the largest exchange operators globally by market capitalization. The roadshows across Boston, New York, San Francisco, London, Singapore, and Hong Kong reportedly engaged more than 120 institutional investors, including major global investment firms. The proposed share sale is structured entirely as an offer for sale, meaning existing shareholders will sell their holdings. The proposed sale of around 6% stake, or up to approximately 148.9 million shares, could raise around 31,500 crore rupees. If completed at this size, it would surpass the previous Indian IPO record of 27,870 crore rupees, set by Hyundai Motor India in 2024. Regulatory approval has reportedly been pushed back by around 3 weeks to accommodate updates related to selling shareholders. The IPO is currently anticipated to open for subscription in the second half of September 2026. This will be a major event to watch because NSE is one of the most important institutions in India's financial market ecosystem. Now here's an important market-wide development. According to Rajiv Batra, Chief India Equity Strategist at JP Morgan, persistent foreign investor selling in Indian financial stocks could be approaching a turning point. After significant foreign outflows, the risk-reward profile of Indian financials is becoming increasingly attractive. JP Morgan believes valuations are improving and expects stronger credit growth ahead. If geopolitical tensions ease and foreign portfolio investor flows begin to reverse, large-cap private and PSU banks could see a strong rebound. However, investors still need to monitor elevated bond yields and funding costs because they can impact bank net interest margins. Another important point is that earnings growth, rather than simply valuation expansion, will be the key driver of Indian equity performance. JP Morgan expects India's corporate earnings to grow around 11% year-on-year in FY27, accelerating to approximately 15% in FY28. Beyond financials, JP Morgan remains positive on the power and automobile sectors while maintaining a cautious view on IT and global software. So if foreign flows start returning to Indian financials, the sector could become an important driver of the next market rally. Now let's move to one of today's strongest performing stocks. Welspun Living shares rallied nearly 8% today, extending their 3-day winning streak to around 14%. The major trigger was an exceptionally strong first quarter performance. Welspun Living reported consolidated net profit of Rs 161 crores, representing an impressive 85% year-on-year increase from Rs 87 crores. Revenue from operations increased 24% year-on-year to Rs 2,795 crores, compared with Rs 2,261 crores in the same period last year. Strong sales volumes, better operating margins, and healthy execution across export and domestic markets supported the company's performance. The stock gained around 7.77% today, taking its cumulative 3-day gain close to 14%. Motilal Oswal maintained its positive view, while JM Financial highlighted margin expansion and further earnings growth potential. So this is certainly a stock investors will want to keep on their radar. Next, let's talk about Biocon. Biocon's US subsidiary has secured supplemental US FDA approval for 2 strengths of Yesintec in single-dose pre-filled auto-injector formats approved. The approved strengths are Yesintec 45 mg/0.5 ml and Yesintec 90 mg/ml. The approval provides a more convenient self-administration format for patients. Following the regulatory development, Biocon shares climbed around 2% to Rs 420.25 on the BSE. Yesintec is indicated for several chronic autoimmune conditions, including moderate to severe plaque psoriasis and active psoriatic arthritis. It is also approved for adults with moderately to severely active Crohn's disease and ulcerative colitis. This approval strengthens Biocon's commercial presence in the US immunology market and expands its portfolio of accessible biologic therapies. Now coming to the EV charging space. Exicom Telesystems has developed India's first indigenous liquid-cooled charging modules and has officially started exporting these components to the United States. The company has developed 25 kW and 50 kW liquid-cooled AC-DC power modules for ultra-fast EV charging applications. Liquid cooling helps prevent overheating and thermal throttling during high-power charging. It can enable continuous high-power delivery of up to 500 amps even under extreme temperature conditions. The technology can also reduce component stress, extend equipment life, and allow thinner and lighter charging cables. Most importantly, Exicom has now started shipping these modules to the United States. The modules manufactured in India are being supplied for the assembly of next-generation tritium DC fast chargers at its manufacturing facility in Tennessee. The company plans to gradually expand production of complete charging platforms in India for both domestic and international markets. This is an important development because it highlights India's growing capability in advanced EV power electronics and global exports. And finally, PCBL Chemical has received government approval under the Electronics Components Manufacturing Scheme for its acetylene black project. The company plans to invest approximately 329 crore rupees in setting up the manufacturing facility. Acetylene black is an important conductive additive used in lithium-ion batteries and advanced electronics applications. The project is strategically important because it can help reduce India's dependence on imported specialty conductive carbon materials. It can also support India's domestic battery and energy storage ecosystem. The project is expected to strengthen PCBL Chemical's presence in high-value specialty chemicals and energy transition materials. It could also help create skilled employment and improve India's integration into global battery and electronics supply chains. Next, Cycle India has received 4 new contracts worth a combined 2,149.62 crore rupees. The contracts were awarded by the Ministry of Road Transport and Highways. Cycle India holds a 74% majority stake in the joint venture with Sushi Infra Mining. The projects involve EPC construction of intermediate lane roads across strategic sections of NH 913 in Arunachal Pradesh. The projects cover important border corridor road segments and come with multi-year execution schedules. All 4 contracts also include a mandatory 5-year maintenance period after construction completion. The company has clarified that the promoters have no interest in the awarding ministry and that these contracts do not constitute related party transactions. So that's all for today's post-market report. If you found this analysis useful, make sure to like this video, share it with your fellow investors, and subscribe to Stock Market Meridian. I'll be back tomorrow morning with another detailed pre-market report covering global markets, important developments, commodities, and the key factors that could influence the Indian market before the opening bell. Until then, signing off, Jai Hind.